Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Taking a look at PayPal this morning, this is a stock that I used to own, did sell it recently, but since it's down about 9% pre-market, it's something that I'd probably be interested in looking into to see if I want to get back into it anytime soon. Q4 earnings came out. The earnings themselves were pretty solid, but some of the guidance and some of the growth areas are leaving investors with more questions than answers, so we'll take a look at that in a second. One must remember as an investor here, this is a stock that's been up 45% in the past year. Valuation has moved from a very attractive 10 to 11% free cash flow yield into that 7-ish percent free cash flow yield. So still reasonably attractive if growth is to continue, but we'll take a look at valuation in a second and take a look at those earnings. So let's take a look at that right now. High-level messaging from PayPal is focus on transaction margin dollars. This is what they're really hitting in their key messages. Profitable growth, returning to profitable growth, transaction margin dollars excluding interest on customer balances up 5% in 24, expecting at least that or more in 25, guiding for $6 to $7 billion in free cash flow, $6 billion in share repurchases in 25, very similar to what they achieved in 24, and then announcing a new $15 billion share repurchase authorization, which is obviously good to see. And this is very much a stock buyback play. The buyback yield here is going to be very good. They went from 1.2 billion shares in 2016 down to below a billion right now, and that number is going to continue shrinking as they believe the valuation here is still interesting enough to buy back shares. For Q4 and full year 24, Q4 actually solid. They beat on revenue expectations. Expectations were close to 3.5%. They actually hit 4. EPS expectations were 113, 112. EPS now they're actually hitting 119, and transaction margins continue to grow. But the one thing to note here is that full year to Q4 24, there's some deacceleration in TPV and total payment volume, deacceleration in revenue, deacceleration in EPS growth. The only thing that's kind of steady is transaction margin dollars, and excluding interest on customer balances, those are actually growing because they're focusing more now on profitable transactions, on profitable payment volume, and we'll take a look at that in a second. Accounts and activity metrics still growing. There was a period of time where they were slowing a little bit or reducing in active accounts, but 2% growth here, 2% growth here, good to see. Number of payment transactions growing in 24, actually reducing in Q4 24 over the comparable quarter last year. And a lot of that is, again, focus on value in terms of transaction margin. So they're focusing on removing those lower value Braintree transactions, those unbranded transactions. And we'll take a look at that in a second as far as what that means for their overall total payment value growth. As you look at this, as you look at the mix of the PayPal's payments platform, you're seeing a pretty clear trend. PSP, unbranded card processing, or Braintree, grew at 30% in 23, down to 14% for the full year 24, and is now down year over year 2% for Q4 24. Clear deacceleration there. That's on purpose in their mind because they're looking at this as, yes, we're losing total payment volume, we're losing revenue, but that deacceleration means we're losing business that we're not making any money on, and that's going to improve our transaction margin dollar growth. Maybe that's a good thing, maybe that's a bad thing, but in the short term, that's certainly going to hit their top line, but be a benefit to their bottom line. The question on the minds of investors is, can they make that up somehow? And it doesn't seem like they are right now. Venmo is growing. It's improving year over year, but it's not improving that much. It went from 8% growth to 10% growth. This dropped from 29% growth to 2% growth. Pretty significant deacceleration versus relatively minor acceleration on a more profitable product. Same for branded checkout, accelerating a bit, but if you look at full year 24 versus Q4 24, basically the same. So you're losing a decent amount of growth on the payment volume side from Braintree and not really offsetting it with anything else just yet, which could be a problem from a long-term revenue growth basis. And yeah, there's some upticks over here, like P2P excluding Venmo is growing as well. Other merchant services are growing as well. But in terms of the amount of payment volume that gets processed through a lot of these things, a lot of it comes through Braintree. And yes, it's less profitable volume, but that means that their top line is going to start shrinking a little bit if this continues. So as you look at the overall results here, you're seeing that show up already in Q4 24 results as there's the deacceleration in revenue. However, it does mean that transaction margins are either improving or staying steady, which is a good thing. Another thing that pops out too is that despite the deaccelerating growth, they're spending more money on transaction related expenses. They talked about investing in marketing and sales on some of these new product releases they've got going, whether it's Fastlane, whether it's whatever. And that is flowing down to the bottom line on a net income basis. Still some growth on an EPS basis, but obviously seeing revenue deaccelerate and non-transaction related expenses accelerate isn't a great sign for investors. Still generating a ton of money. The question then becomes, what does this look like going forward? Is this revenue thing a temporary blip, or will it continue for a more extended period of time? Before we look at that, though, one thing I always look at as a PayPal investor, or when I was a PayPal investor, is again, transaction margin does matter. It's not all revenue based. Even if revenue slows and transaction margin keeps improving, the bottom line will keep improving. So that's important to take note of. And then transaction margin as a percentage, that's also moving in the right direction ever since Alex Chris took over, which is a really good thing to see. One thing I noticed when I was looking at this a couple of years ago or a year ago that worried me is that transaction margin kept shrinking and shrinking and shrinking. And I think the PayPal team also noticed that, and now they're focusing on improving that, even if it means that the top line will start to slow a little bit, because the bottom line will benefit from it in the long run. So let's look at guidance for 2025. And I think this is where the market gets a bit concerned about PayPal going forward. Guidance here looks okay on paper. You've got transaction margin dollars growing for Q1 and full year 2025. EPS that's in the 6 to 10% range versus a 7% expectation for the market. Free cash flow in the $6 to $7 billion range, which is kind of what the market expected, or even maybe higher. A lot of share repurchases. But one thing you don't see here is revenue growth. They didn't give it on the slide for Q1 25. On the call, they said it's flat to low single digits, which is probably a bit lower than the market expected. But again, that's losing some of this lower transaction margin business, which still leads to transaction margin dollar growth. Then for full year 2025, they kind of dropped a bombshell where they said there's potentially going to be a 5% headwind on revenue due to some negotiations with larger Braintree customers. What that tells you is we're planning to lose some of their business, some of their total payment volume. That's going to flow down to lower revenue growth, if any revenue growth, because of that 5% headwind. However, keep in mind that this is business that's going to generate low to negative transaction margin dollars. So if we lose it, despite the fact that it's going to be a hit to the top line, it's going to improve our margins on the bottom line, going to not really impact our free cash flow, if not improve it, and it's going to improve our transaction margin dollars. Now, do you see why their key takeaways on slide 1 were based on transaction margin dollars? Well, it's because revenue growth in the short term is probably going to be mediocre because of their focus on more profitable business, and the idea is that they're going to be very comfortable losing some of that total payment volume because it's not additive to transaction margin dollars. And that's something you have to keep in mind as an investor. When you go into 2025 revenue expectations, they're probably going to have to get lower than they are today. And that's probably why the stock is down a little bit. As we think about the market's response to these earnings, you sort of think about, well, what were revenue expectations for 25 onward? Those were in that 5 to 6% range. What are they now? What are they going to have to change now? And 25 has that 5-point headwind. Probably means that revenue growth in 25 is going to be at best low single digits because of that headwind. Maybe there's some upside from Venmo. Maybe there's some upside from monetization in PayPal and their branded product. But right now, it's looking a bit more dire on the revenue side. And then also, what does that mean for 26, 27 onwards beyond 25, which is looking a bit more dire? Now, PayPal's response is going to be our margins are improving. We are focusing on growing our profitable businesses and shedding some of this payment volume that we're not making any money on. So transaction margins are going to go up. However, you must be aware that the market always looks at a revenue growth dip as a negative thing, and then later down the line, we'll evaluate how it looks on the bottom end. Like if free cash flow keeps growing for the next couple of years because margins are improving, even if revenue slows down, is this going to be a profitable stock for people buying today? Probably, but it does mean you have to probably reassess your valuation of the stock versus what you had before, which is why the stock is down as much as it is. So let's take a look at the valuation. And disclaimer, this video is purely for informational, educational, and entertainment purposes only. It is not investment advice. Note that the market has opened. Stock is trading in the low 80s, so down quite a bit from yesterday after these earnings. This is a company that buys back a ton of shares, so you're talking about 5 billion or so every single year, offset in a way by stock-based compensation in the neighborhood of 1 to 1.5 billion. However, with an $80 billion market cap, you've got a $15 billion share authorization, so you're going to buy back 20% plus of the company pretty quickly in the next couple of years if the stock price stays where it is. Revenue growth, we've got the actuals for 24, 6% growth, almost 7% growth in 24, low 20% margins. For 25, I'm dumping that 5% growth down to about 1%. That 5% headwind is a concern. Probably some upside from Venmo monetization, some upside from branded, but obviously you've got to reduce your expectations for growth in 25. Margins kind of get you to that midpoint of the $6 to $7 billion free cash flow guidance. Then you've got a return to growth, 5, 4, 3% for the next couple of years with margins improving a little bit. Maybe conservative, maybe aggressive. You can play around with this spreadsheet if you'd like. Just hit file, make a copy. There will be a link in the description down below. What are they doing with their money? Most of it goes towards buybacks. I have 75% of the money going towards buybacks. They do not pay a dividend. Probably will in the next couple of years, but not right now. So that means $26 billion in buybacks in the next 5 years, inclusive of 24, offset by stock-based compensation leads to about an $18 billion net buyback. Does leave them with about $8 billion, $9 billion worth of free cash flow in excess of their buyback. So they may just buy back more shares. They may issue a dividend. They may make some acquisitions. So keep that in mind. There's some additional money here. Play around with it if you'd like. What's the fair free cash flow yield for something like this? Historically, I've had it at 7%. I'm going to leave it there. You can play around with that number right here. On a actual 2024 basis, you're getting an 8.4% free cash flow yield in the low 80s. If you're using a 7% free cash flow yield as a fair value with these assumptions, with slight growth, with improving margins, with a significant buyback, you get about an 10% expected return, including buybacks, from today's price point in the low 80s. So if you're looking for a 10% target return, your fair value is basically right around where it is today. The question becomes, this revenue is slipping. Is an 8% free cash flow yield the right number? With that in mind, yes, transaction margins are improving, but this is a company that's sort of moving in a surprising direction. The new CEO's whole thing was, we're going to grow profitably for sure, but we're also going to grow. However, the market isn't seeing that growth right now. In 24 they are, but based on the guidance in 25, things are moving in the wrong direction on the growth side. You're not seeing all of the stuff that's being talked about in their Venmo product, in their branded PayPal product, show up in terms of driving additional growth. And you're definitely seeing a deacceleration in growth in Braintree. So that's concerning to the market. So if you think about it that way, do you place the free cash flow yield at something more conservative? So you get a fair value that's closer to $73 and a total return from today's price around 7.7%. Are you on the opposite side? Are you a bit more aggressive here? You can kind of get a fair value in the low 90s with a 6% free cash flow yield and a total expected return of about 12, 13%. So that's kind of how you play around with this stuff. In my mind, $81 seems like the right number for something like this, seems very fair. Would I buy it at 81? Note that I did own PayPal in the past, do no longer own it now. 50% return was good enough for me. I don't think so. I think I need something closer to, maybe a 15% return. So again, this getting back down into like that $60 to $70 range, which I don't think will happen because this is still an interesting company. However, it's something I'll definitely keep in mind if it gets there, if it keeps floating downwards, because at that point, it would be a very interesting valuation. At today's price point in the low 80s, it just seems like it's priced okay. Would I buy this over just the stock market, over anything else, with the new knowledge that, hey, revenue is going to be pressured in 25. And yes, it's benefiting the bottom line. But how will that pressure translate into 26? They have a bunch of large customers up for negotiation with Braintree in 25. Is that going to be the case in 26? It just opens up this bucket of unknowns that makes me a bit weary, which means that, yeah, the fair value is 81, but I probably want at least a 10% margin of safety here, which gets me into the low 70s. I'd probably be a bit more conservative on my free cash flow yield, which again gets me into the low 70s. So at that price point, low 70s, high 60s, I'd be interested. At this price point, it just seems like it's an okay buy. If I was a investor looking to invest in something, would I be very concerned about buying this at 81? Probably not. But I would acknowledge that, PayPal historically hasn't had the best momentum. The market's going to look at this and say, well, revenue estimates are now moving in the wrong direction for 25, for 26. Maybe we have to reprice this a little bit. And some of that is being done right now. But will this have some downward momentum after the earnings? Potentially. I'll certainly watch their investor day in a couple weeks rather, see what that looks like. And if that looks interesting, if there's some interesting things down the line for branded, for Venmo, then maybe, just maybe, some of these assumptions are too conservative. And if you think so, then today's price point is probably a gift. However, if you're a bit more of a conservative investor like I am, then you probably are looking for a bit more. They have that Honey lawsuit too. I don't think that's a huge deal, but something to keep in mind. So a couple of things here stand out. These earnings for Q4 for full year 24 are solid, but the guidance for 25, the growth deacceleration in Braintree, the lack of significant acceleration for Venmo and PayPal, that's what's concerning me. And that's why I feel like at 81, this is just a fair price. And if it keeps dropping, I'll revisit. However, for now, probably a pass for me. What about you? What do you think? Are you in agreement with me? Do you feel like I missed something? Are you concerned about what's going on in 25 on the top line? Or is it not a huge deal because the free cash flow is still going to keep flowing? And that's the thing with this company. The free cash flow is likely going to keep flowing. This is still an interesting value investment at this point because you're getting it at 8.4% free cash flow yield on a 24 basis, on the 2024 actual basis. And that's not bad in this market. And if they can even grow their bottom line at 2 to 3% and then return, 4 to 5% to shareholders via stock buybacks, then you've got a decent value investment that certainly looks interesting at today's price point. Just for me, it's not enough. If it gets back into that, 10 to 11% yield range like it was a couple of months ago, would I buy it then? For sure, I'd be back in. But right now, it just seems fairly priced. And for me, I'm okay with my allocation to payment stuff. I already have Visa, I already have MasterCard, I already have Apple, and I probably don't need more in a space that's very competitive. So that's my take. What's your take? Leave a comment down below. If you enjoyed the video, like it. If you're new here, subscribe, hit the bell, whatever it is people say. Thanks for watching. Bye.